The other request from Jim I can do now is EROAD. This is a company I'm not familiar with. It doesn't get much coverage. It's a New Zealand company, so it doesn't really have much of a profile in the Australian analyst community or press, financial press. Interesting company though, and was great fun to research. I guess you could sum it up as being a transportation technology company. Or a fleet management telematics company, but basically does a couple of things. But one of the main ones, which seems to be getting legs in New Zealand and inroads into Australia and importantly North America, is they put a little device in a truck or a car that's part of a company's fleet that transmits data back to software, and the fleet manager can look at whether the fleet's being optimized properly and save on fuel usage and other utilization costs. So interesting sort of company. I think this technology may have been pioneered by the insurance companies, because I know when I was in Canada, our insurance company sent me such a device to put in the car, and it was meant to send data back to the insurance company, who would then decide whether they would risk-based price my insurance based on how carefully I drove or not. So I put my price up if I was a redhead and put it down if I was safe. We didn't stay in Canada long enough to get any data from that, but that was an interesting concept. Similar one being used by this company. Looks like it may have had a history in a particular thing that happens in New Zealand called road user charging, which happens in Australia too, but everyone pays through it through the bowser, through the petrol price, which they do in New Zealand as well. But once a truck reaches above a certain tonnage, which I think is about 3.5 tons, then they're deemed to be a heavy user of the road, and sometimes they're seen as being a cause of potholes and more damage to the roads than smaller vehicles, and so they have to get a license called a road user charge, and so it's a cost per 1,000 kilometres, and they sort of buy them based on what they think they'll need, and it's all up in. Historically, it's been a manual system. You go in and apply for a license based on what you think you'll need, pay a cost, stick a license on your window, and it can be monitored by transport authorities, I guess at weighbridges or something like that, to see how much you've travelled and if you paid the right license. Very manual process and probably not that effective, I wouldn't have thought. But this company has been able to electronically improve that process of road user charging. And there are other uses. So there are other countries in the world that do this, and there are other countries that do things like, in the city of London, you pay a charge if you drive your car into the CBD, that kind of thing. So there is other applications for electronic road user charging and tolling than just in Auckland or in New Zealand. So this could be exported. But it seems like the main part of the business is in this fleet management telematics, which is very interesting. The company can report on things for a fleet manager, as for example, as to whether or how often the vehicles go over speed limits, which is not just about avoiding fines, but if you think about it, that's a heavy use of fuel if a truck is revving up to go over the speed limit. And there's been reports and case studies showing that the fleet can save 20% in fuel costs by keeping the vehicles under the speed limit, just getting information about that. But also things like whether the cold chain storage is being optimized, whether you're better loading trucks with the stuff already refrigerated or paying the cost to refrigerate them by running the motor heavier in the truck, that kind of thing. And also to just utilization. So are the drivers taking the optimal directions to their deliveries or not? So yeah, I can see the benefit of this. It's starting to get some high profile users. So I think they list Boral in Australia as one of the companies that use it, and they have a fleet of cement trucks. Another company in Australia called Program, which I think used to be called Program Maintenance and may have been listed on the ASX. They have a company called Cisco in the US, which SYSCO, not the router company, but the company that delivers wholesale food and equipment to restaurants, which has a big fleet of vehicles in the US. So it's gaining some traction and growing. They recently did a capital raise to put them on a better financial footing, but also to help fund expansion. So that may happen again because they're pretty much running at least break even, I guess. A lot of the costs in this company are in R&D to improve their telematics, and they've recently signed a partnership deal with Microsoft to use AI to troll through the data and give them other insights that they can pass on to their fleet managers. So currently, I think R&D was running at about or 12%, I think, of sales. It's high, but it's shrinking as a percentage of sales, which makes sense. And it looks like that's where they've been putting their spare profits into, which also makes sense for a growing company. So yeah, interesting company, interesting what they're doing. You can see definite uses for it. However, it's still a small New Zealand company. I think its market cap's around 180 million. ADT for this company is small. Just try and find that ADT. I can't see it offhand, but I think it's around 50,000 from memory. I'll just look at Stock Doctor and work it out. Okay, ADT is, yeah, $50,748. So it's not going to suit everyone. It's a small company. It's recently gone across its 3PTL buy, so that's a good thing. And what else can I say about the numbers? It's share price for the analysis is 97.5 cents, which is just above consensus target. And it doesn't have an IV1 and IV2 because the current earnings per share was negative, so we can't calculate. Doesn't have a yield because everything's going back into R&D. Stock Doctor financial health hazard is early warning and steady. That makes sense, I guess, if it's a growing company and plowing money into its growth, it's not going to have a strong financial position. I guess that's reflected in the current PE, which is 4,000 times, so we can't really score it on that. But however, the prop CAF is 5.7 times, so that suggests it is getting a lot of sales. They're coming in, but going back into growing the business or R&D research. Net equity per share, $1.43, which is below its share price, so that's good. NTA, though, however, is only 21 cents per share, so that usually means that there's a fair amount of goodwill on the balance sheet, and that's probably the case because I know this company has acquired a number of companies along the way and put them together into this sort of data management, fleet management company. So that, even though we score it for being below net equity per share, it is above net tangible assets with its share price. We don't have a forecast growth available, so I can't score it on that, but management are calling out growth. Obviously, they're in growth mode, so I'd expect that to be the case, but we can't score it. So our scoring is perhaps a little low by that metric. Directors only hold 2%, which I thought was interesting. Again, I would have thought there'd be an owner-founder in a company like this, but we're not seeing it, so we can't score it for that. It's a recent buy on the buy list, so we score it for that. It almost had consistently increasing equity, but I think there was one half where it went down slightly, so we can't score it for that, but it was pretty close. So all in all, quality is 7 out of 15 or 47%. But as I said, there could be a couple of scores we could add back to that in time. QAV score is 0.08. So just below, again, our cutoff of 0.1, but wouldn't take much of a share price, decline by a cent or two to bring it back onto the buy list, or you just wait for further results in the future. Risks for this one, I think, you got to call out the fact it's a small company based in New Zealand and it's growing. So it's going to have all the normal risks you have buying these kinds of stocks. They may do another capital raise for an acquisition or to fund working capital or whatever. So that's always on the card with these companies. Uh, does seem like though that's been paid back because the share price is up since the raise was done. Um, I think probably the biggest risk that I can see for a company like this is barrier to entry. So, like I said, those vehicle monitoring units were being used by the insurance companies in Canada and North America. Looks like it's a similar type unit that they're selling. So, if the units are readily available, then it's really comes down to how good is their um, fleet management intel, I think. It does do other things, like it does sell dashboard cams and allow, incident review. If there's been an incident, they can review the video recorded from the dashboard cam. But again, they're also readily available in the market. So I think the real IP for this company is on how good its fleet management intel is. And, you wonder how long it would take a US company to reverse engineer that and go after that market as well. So I think that's probably the biggest risk for this company. If they are well established in the market, and they seem to be, that they're getting like a 90% plus re-sign up from companies that use their service. So that's a good thing. But you wonder how long it would take for someone else to come into the market with similar sort of software using units they can probably buy cheaply and send out to cars and fleet managers for their cars and trucks, and then start to develop their own fleet management intel as well, perhaps using AI. So, yeah, it's certainly worth looking at, but it has all the usual sort of small company risks associated with a growing company like this.